All right, everybody, this is John, and welcome to the free video. So S&Ps and the Qs down pretty decently today. Actually, over 1%. That always shows conviction. Of course, in the big scheme of things here, we've come from about 370, rallied not quite straight up, but pretty close, up to 400. That's pretty big, and we've pulled back to the 21 EMA. We do have an RAF sell here. On the other hand, we do have a squeeze that hasn't fired yet. So the question is kind of what gives, right? What's going to happen here? So let's look at the Qs. A lot of earnings today too. We'll take a look at that. Qs, same story. Exact same story here. In fact, we've already fired to the long side. And then the big earnings today were Microsoft and Google. And I think everybody was expecting a collapse simply because of what happened after Snapchat. And so Microsoft earnings came out, and it looks like, I mean, it was down $7 on the day, but it looks like it's stable. Like that, essentially that was the earnings sell-off. And so after hours, it's up about a buck, give or take. And of course, Google was also one, and it's already sold off into earnings. And then after hours, it's up about $2, almost $3. Where is it going to end up tomorrow? Don't know, but typically, if at least you're getting a little bit of a bounce after earnings like that, especially when expectations were so negative, that generally bodes well for kind of a positive move there. So the big thing is going to be interest rates, and it is widely expected that the Fed, there was a chance that they were going to raise, let's look at the bonds here, they were going to raise a whole percentage point. Now that looks like it's dropped to about 0.75%, so 0.75. And that's kind of the consensus right now, and it may change, but the short version is they're certainly talking up how inflation is very scary right now. I think anybody that's living in the real world sees that recessionary pressures are already here. Restaurants are dying. If we look at, say, Eat, that's a restaurant symbol, restaurant chain. This is just death. Restaurants are empty, depending on where you are. I mean, it's hard to get a seat in Austin, where I live, but in terms of across the country, there's certainly been a slowdown in consumer spending and things like that too. I saw a stat today that whereas a year ago there were about 60 million Americans kind of living paycheck to paycheck, that's up to 90 million. I don't know how they figure that out, but the idea is that the slowdown is kind of here. I think at this point the Fed just needs to see evidence in terms of like employment, that employment is coming off and housing is coming off, and the numbers are there. The thought here is that they're going to overshoot and kind of put us into a, really the question is do they put us into a steep recession, or is it going to be a mild recession? And I think it's going to be a mild recession, but at this point, and the reason I'm showing this is that this is where, even though they're going to raise rates tomorrow, interest rates already peaked. So remember that interest rates, yeah, they raise rates, and these are based on the shorter term notes, but the 10-year is what drives mortgage rates. And even though they're going to raise rates tomorrow, it doesn't mean that bonds will plunge, because the bond market moves more in relation to the economy. And so now the bond market has bottomed because it's already looking out and seeing a slowing economy. And so believe it or not, even though the Fed is raising short-term rates, and we're talking like 3-month, 1 month, 3-month, those kind of notes, the 10-year has already peaked. And so if we look at TNX, which is the actual interest rate here, based on the 10-year notes, you can see we had this huge move from about the end of February to here, where interest rates like doubled, and that's also when mortgage rates spiked. Well, since then, I mean, they've come off quite a bit from about a high of almost 3.5%, and now we're sitting at a little under 3%, and I think that top is in. So anyway, we got a lot. So this week we've got the Fed meeting. All eyes on that. So it's been pretty quiet. These have been the least volatile week we've had so far this year. And we've got GDP, and I think there's going to be a lot of volatility unleashed. It's hard to tell, honestly, which way the market will go. I do think that ultimately we're going to continue to see kind of a grind higher into September, and then from there we'll get probably a retest of the lows. So going to be some volatility both ways, but I don't think we're going to roll over and see the kind of moves we were seeing, back in May. All right, hope it helps. You guys have a fantastic rest of the day, and we'll see you at the next update.
Hey, John here with Simpler Trading. Thanks for watching. If you enjoyed this video, comment down below. And let us know what topic you want to see us cover next. Also, be sure to subscribe and click the bell icon so you can get notified when we release new videos. And if you want to watch us trade in real time using our own money, go to simplertrading.com and learn how to sign up. Good trading, and we'll see you next time.